All right, guys, it's been a while since we did this, and I have to warn you that tonight's content could be a pretty significant nerd out. So for those of you who want to do that, I've saved some of the more complicated content really towards the end. And those who want to stay a little bit longer at the end and kind of nerd into all the different things that we're going to get into, you're more welcome to do that. But I try to make it as easy as possible to follow, and I'll just hop right into it. So I'm going to share my screen.
And Itai, at some point, will you cover the option lambda?
I don't think it matters for humans to know what it is, and rho is the same way. So rho used to mean something when rates actually mattered, but they don't anymore. So you can ignore rho. Probably should be taken off the textbook. All right, guys. So we're Equi, as Jeremy has very eloquently explained. We are the future of alternative investing, and I'll hop right into it. Sometimes I like to do a little macro update before getting into the main topics. So we're going to do one tonight as well. So Friday was Jobs Day. It was the non-farm payroll day, and we're sitting on an incredible, think about it. We just came out of COVID with all these lockdowns and restrictions and all these things. And we're now sitting on an incredible record 10 million job openings in the country as of right now. And what's really amazing about that is that there are actually 1.371, almost 1.4 million more job openings than there are unemployed workers in the entire country. So if every unemployed person today that is registered by the BLS, Bureau of Labor Statistics, got one of these jobs in the current opening, there would actually be 1.4 million jobs extra than unemployed people. This, of course, doesn't take into account the participation in the labor force numbers, but this is based on the current amount of total unemployed registered. So this is one of the ways I like to look at it to kind of get a long-term sense of where the job market is, given the historical context. And in red, you can basically see the total amount of job openings, right? Going back to 2000. Then in blue, you can see the total amount of unemployed people. And then in purple, you can actually see the ratio between unemployed persons and job openings. So right now, that ratio is sitting basically at the cycle as if it was pre-COVID, with less than one unemployed worker for every openings. So at least based on the general statistics, this is one of the hottest jobs markets on record.
So Itai, is it safe to say that if you really dislike your employer or have been thinking about making a move, that this would be the best and most opportune time to get that done?
This would be one of the most opportune times to get that done. And we've seen that. So we've seen almost record amount of quits and changes, and the employers are feeling that this is a much pro employee, or if you're seeking work type of market than otherwise. So for example, Jeremy, when you got into the jobs market right around this period, it was quite the other way around, that there were more than 6 people competing for every open position.
I remember that. Motorola was the only company that ended up giving me a job offer, and things went incredibly well for them after they did that.
Right?
I have to just have a little bit of fun, everybody. It's a Monday night. Come on.
So I've gone this before, that people say, well, maybe the total amount of jobs opening is because employers are not hiring as quickly, but that's actually not true. Based on the last jobs number, we've almost seen record amount of hiring simultaneously. So not only you have over 10 million job openings, but also companies are hiring at a record pace. And nonetheless, there's still a massive amount of demand for workers out there. So this is not a surprise then, that given the, and we've talked about this in our inflation call. So, and also now with the Delta variant, we're seeing more supply side problems. Inflation is already somewhat of a problem, with the New York Fed inflation expectations are now at around 5% going forward 12 months. And the situation of the labor market, which wage inflation is one of the things that drives inflation the most, is potentially going to stay here for a while. So let's talk for a second about the big balance sheet, which I like to remind people every now and then because we seem to forget about that that's the new normal. So here we see the total assets on the balance sheet of the Fed, ECB, and Bank of Japan. And this is not money printed. So this is not to be confused with money supply or M2. This is actually securities that they purchase in order to provide market liquidity. So because this is a ratio scale, you don't really see the size of what happened during COVID, where the global balance sheet goes from about 14 trillion to just under 25 trillion, which is a massive increase in a very short period of time.
So that means that they have bought $9 trillion in securities, and then that's their way of pumping more of that money into the system, correct?
Correct. Almost 10 trillion in just security purchases. That doesn't necessarily include what banks do, because they're going to have to park liquidity, and it doesn't take into account the multiplier effect.
So where did all that liquidity end up?
It's a good question, and we'll dive right into
it. We'll hit it. All right.
We're definitely going to hit it.
Okay.
So you can argue that now there's too much liquidity, and at the same time, the job market is stressed, and all these things are happening. All these opening of the economy after COVID, and it is expected for the central banks to taper somewhat, and in 2022 get back to what I would say normal QE, which is what happened between 2009 and currently. I don't think we're in a no QE world anymore. It's probably going to be just varying levels of QE going forward. And at the end of the day, even if they do taper, I think we have to realize that there is a tsunami of liquidity. Even if at the end of the month, Jackson Hole, Wyoming is when the Fed typically announces big policy changes. If they decide to have a big policy changes, it's more likely it's going to happen in Jackson Hole versus in a Fed meeting. And if it does happen, there's still a good amount of liquidity in the system. So answering your question, I find that a very, very interesting chart. Here in the dark blue, you can see the Fed funds target rate, or you can think of it as how much money you get paid for sitting in money markets. So there was a very short period of time in 2018 and early 2019, you're actually getting 2.25% on your money sitting in short-term money markets. And then here you can see the amount of money sitting in those money market accounts. So here's COVID. And as rates go to zero, we're sitting on over $5.4 trillion in just money market funds. And I'll ask you this, how long are you willing to take 0% return on that amount of money, knowing that we have 5% expected inflation?
So I think that has some major implications, because if everybody's sitting here saying, hey, asset prices are already crazy enough, and eventually there's going to feel heat to put that money to work because it's depreciating by the day, this could all find its way into assets even further, pushing this bubble even more.
Yeah, and the professional lingo, this is called Tina, or there is no alternative.
You love talking about that one. I feel like I hear that a few times.
And the first time I heard about Tina, it was in 2011, which was the first. And you know what? Tina has been a valid investment strategy for a decade now, and unfortunately, it continues to be.
I hear in some markets, tuna is also a valid in investment strategy. I guess it just depends on who you're asking,
For sure. So it could actually be worse. So in some markets, for example, this is the 10-year Bund yields after you adjust it for inflation in the European Union. They're sitting on a negative 4.2% real yield if you're putting it in the Bunds, which are negative on a notional basis, almost, but they're also dramatically negative on the real basis. So we're going through the greatest experiment in modern economics, where the developed world is experimenting with types of policies that have never been tried before, and it's very difficult to predict how this is going to all end up. So what the Fed was very successful in is triggering the largest passive global equity flow in history. This is the flows into the global equity funds, and this year they're currently sitting at 837 billion. It's coming out to about 21 billion a week or 4 billion a day. of passively allocated buy the dip funds. So these are these are funds that buy the dip any and every day on a passive basis going into your favorite index fund.
Is this the reason why we've seen these down days only happen for such a short period of time and then immediately spring back up?
That would be definitely a part of it, as you're having a consistent bid under the market that has not shown any signs of subsiding so far. And that resulted in the following chart. So if you look at things, and that would be Facebook, Amazon, Apple, Netflix, Google, and Microsoft. As of today, they have a market cap. So this is August 6th. They have a market cap of $9.4 trillion, approaching a $10 trillion mark. And the S&P 500 is about a $32 trillion market cap. So it's interesting when you're saying, well, you know, I'm going to go into a passive strategy and buy my Vanguard fund and get exposure to a diversified S&P 500, 500 stocks, but you're basically buying yourself into very large tech companies with a very high concentration.
And this is basically the reason why we've created Equi, you know, because we wanted to find things that are not necessarily correlated to the markets, understanding that there's this much passive flows into the largest tech companies and largest companies in the country.
And we've also seen the privatization of alpha. So what I mean by that is, you know, you used to have about 8,000 or 9,000 publicly traded securities, and now we're actually down to just about 3,500 to 4,000 publicly registered securities. So even though the market caps are going up and up and up, a lot of companies choose to stay private or for longer, or just stay private altogether because they don't want to necessarily be on the whims of these fund flows. So I think this chart is total mind-boggling. Starting here in 2013, this is the performance of FANGs versus the total S&P 500 in blue, and versus if this is it would be the S&P 500 if you took FANGs out. So when you're thinking about concentration risk, if you imagine that this chart would eventually have some sort of correction at some point in the future, how would that affect the broader index? And what kind of concentration risk do you really have in what you would think is a diversified stock market?
Yeah, Itai, just real quick, I remember reading, I was doing some S&P research, and they talk about what I term the recursive effect, where funds pour in, the biggest allocations or the biggest market caps that you're pointing out go up, and then that in turn causes the S&P to go up, which more funds pour in, which causes these FANGs to go up, and there's just this recursive build. It's like a self-perpetual machine to a certain point.
It is, and I know what you mean. So it's like at some point they're getting awarded for liquidity versus necessary, and that triggers more performance and higher valuation, et cetera, et cetera.
Itai, one of the questions that came in the comments is, what's your take on the ratio of market cap to GDP? And you know, for you, is that a good measure of market valuation?
Yeah, market cap to GDP, or the historical Warren Buffett indicator. Basically was, you know, if the total size of the economy is the stock market is greater than that of the economy, the market's overvalued. But the problem with that is that it hasn't worked for quite some time. And as the famous Keynes would say, market can stay irrational longer than you can stay solvent. And we'll talk about what happened to shorts soon.
And was it really the beginning of the QE era that blew that out of proportion?
It really is. And it's almost like, the way I like to think about it is that there was a certain set of rules for trading and investing pre-0809. And then there's a different set of rules for trading and investing post-0809. And the problem with using some of the things that were used before is that in an era where the Fed is really the biggest determiner of market liquidity, and market liquidity is what determines price, it's very difficult to trade on fundamentals. And it's one of the reasons you've seen the value versus growth performance really look like crocodile jaws, right? In the past, they would kind of like swap around and things like that. But growth has so much surpassed value as of the recent years that it's not even a comparison. So it's very difficult to know when things are going to revert to a kind of mean. And you know, it's a longer discussion than this, but interest rates also have a lot of weight when it comes to that, because valuation are a factor of interest rates to a point, and it's easier to have higher leverage and higher percentage of market cap when it's really easy to borrow money for very cheap. So I think it's a very complicated question.
Also, Itai, I think normally the charts are a lot easier to see. I think when you shared the screen, I think it tried to share the full monitor instead of just the screen. Could you maybe try like resharing the PowerPoint? See if that works. Because there's a lot of black space.
Is it working or no?
We can see it. It's just small. I think it's because it's not sharing the full, or it's trying to share the full screen.
Like it may be your screen resolution on your second screen or something.
So what I have is one ginormous screen.
Yeah.
It's just ultra wide, and that could be the reason.
That'll do it.
Yeah, it could be that you just need to share like the specific you need to
Just the
sometimes
deck itself.
yeah. Like
Yeah,
shift
so
the deck.
I did do that. So let me try to do. Does this make any difference?
No, it's
It looks like the same thing.
Okay, so
something you could do is just share the PowerPoint, just the app instead of the whole screen, and then yeah.
Okay.
Sorry to interrupt everything, but
We're gonna give it. We're gonna let Itai try this really quick for 30 seconds, and if you don't get what you want, you can just hold on really tight, because we'll keep you engaged with some type of interesting content. Oh, look at that.
Yeah, see that's actually better. Yeah.
This is much better.
Sure, but the problem is that now.
Do you want to just click presenter mode or click play?
Yeah, but then it goes wide again, and then.
So then just go back, and it's okay. Everybody don't look ahead, okay? That'll be what you're trying to do.
You can also close that sidebar. Technical difficulties.
Sorry, guys.
That's okay.
All right, I'm just gonna continue so we don't spend too much time on this.
Sure.
All right, so there's also another thing here at play, which not a lot of people put attention to, and that is the liquidity trap that we're currently seeing in the banking system. So we mentioned the fund flows, we mentioned $5.5 trillion of money in money market funds, but there's also a big divergence between the amount of deposits and the amount of loans out there. So in the past, or in classic economic theory, it would have been known that deposits tend to create loans, because as you have more deposits, banks want to make money. And what do banks do to make money historically? They make loans. And then as they make loans, that money disappears and there's a certain ratio. So you can see in the 90s all the way until 2008, it was actually true where the deposits and loans were matching. But as we discussed before, there's a certain rules pre-0809 and there are other rules post-0809. And I think this is one of the biggest ones. As of today, or especially post-COVID, we've actually seen loan demand taper off. And loan demand actually hasn't gone up that much since 0809. It's a very, very gradual increase, if that. But the total amount of deposits and cash on the balance sheets of the banks, of the big banks, these are the big four, JP Morgan, Bank of America, Citi, and Wells Fargo. So today, the banks are sitting at 7 trillion in deposits, but only 3.6 trillion of loans. Look at JP Morgan as an example. I think this is crazy. JP Morgan has more than 200% deposits than loans. Another way to think about it is that only 45% of the total deposits that JP Morgan has are lent out. So historically, what banks have done in order to make money is very difficult for them to do in a low interest rate environment. And the Fed has created so much liquidity that there's just a glut of money sitting on bank balance sheet that's not even going into the economy. So an interesting thought experiment would be, assuming the Fed does taper off, what happens if all that insane amount of money in the banking system does end up in the economy at some point? And this is one of the reasons it's been very difficult to be short as well, as Jeremy mentioned before. We've seen short interest in the S&P 500 hitting what is a very, very low number historically. And who can blame them?
Yeah, and so that's actually, so there's something really interesting here, which is that the shorts are really important to make sure that prices stay within a reasonable point. But if you have all this money printing, asset prices continuously going up, a loss of short interest, to me, this feels like bubble, expand, 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 expand. So what type of world are we setting ourselves up for?
Can expand further for years to come, right? And you can say that we've changed the rules potentially. It's just so difficult to know, but I would support your claim. Shorts historically have actually been known to stabilize markets in some instances. So for example, some European markets during the crisis that banned short selling, they were having more difficult time in their financial markets than those that did have shorts. Because if you think about it, imagine you're going through a crazy market crash where nobody wants to buy because there's an insane amount of uncertainty. The only buyers are actually shorts that are buying back their shares in order to realize their profits. And they're actually creating buy into the system, which stabilizes it.
Cool.
So what's, correlation is not causation at all by any means, but what's interesting to note is that if you look at the Fed's balance sheet and you overlay it with the excess amount of deposits over loans, so another way to think about it is how many more deposits you have than just loans outstanding, the excess amount of balance sheet, it almost correlates perfectly as that amount just grows with the Fed's balance sheet. And I would look at it as a type of evidence that a ton of that money is ending up in deposits in the banking system and not actually going into the economy.
So the QE may not really work the way that people say it does. It gets stuck in the system, and it also leads to Main Street inflation, the way that they're doing it.
Yeah, I would say it's actually leading to the asset price inflation and basically having few people having access to that money than a wider amount of people, which, if a wider amount of people had access to it, you may actually have ended up with even more inflation, but that's a topic for a different day. All right, so one of the things that is allowing us to get away with this is that, remember, we had a very long call, three-part call in the US dollar, and it's the petrodollar system. So when we create dollars in our system, we are in fact giving it to the rest of the world. The US can get away with it because the dollar is the global reserve currency. In the past, when other nations experimented with this type of monetary policy, it did not end well, but none of them had the global reserve currency.
Itai, I know you're not going to like hearing this, but this is a good screen to see, but nobody's able to see it because it's so small. So the question is
how about this? Did this work?
And it did nothing different.
Okay.
So the question is
that helps. That helps when he zoomed in.
Did it? All right. Okay.
Not really.
What's the 60%? So 60% is the American dollar.
If you did the PowerPoint view, would it make it impossible or no?
Yeah, but then I won't be able to do presenter. It's really weird because it goes to my full screen and I am fully able to see it. We should have figured out before the call, but.
All right. Well, you get 10 lashes after this. All right. Gladiator style.
Sounds good. I see it normal on my screen, but.
All right. Well, I guess we're going to have to deal with it. So why don't you explain to everybody what is happening on this screen?
Yeah. So on the screen, we're seeing that as amount of FX reserve, 60% of the world's central banks still hold dollars as their FX reserve. And the dollar is still the most traded currency out there. So for example, 27% of the entire FX market is Euro USD, 13% is USD JPY, 11% is Sterling USD, known as cable, et cetera, et cetera. So almost the entirety of the world's most traded currencies are still dominated in dollars. It's actually just about under 30% of everything is non-US against something else, which is insane. All right, let's move on and let's get into our main topic for today, which is going to be options. So the reason I decided to have this call, particularly about options, is I've had a bunch of calls in the past couple of weeks with potential customers that are being onboarded to Equi. And a lot of them actually had this problem where they had exposure to a specific stock that created a lot of concentration into one investment. And they were wondering what they can do about it, as far as how do I divest away? How do I hedge it? How do I use it? So I think some level of option knowledge is really good to have in order to know how to turn a liability, which could be a single stock risk, into a potential asset. And let's hop right into it. So what are options in general? Option is basically just a derivative contract on an underlying. A call option gives you the right to buy an asset at a price, and a put option gives you the right to sell. And it's more important than ever to know what options are, because options are becoming an increased part of the market. Option volume actually is higher today. It's 140% of share volume. So there are more options to trade out there than there are underlines for those options. Okay, let's talk about what a call option is. So Jeremy's a real estate guy, and let's say that Jeremy goes out and he goes to a third party and he wants to buy a house, which is something that he does frequently. And let's say that house would cost $100,000. So he goes to the seller and he tells the seller, hey seller, I want to buy the house from you, but I don't want to buy it now. I want to buy it 30 days out from now. And in order to get the right to buy it in 30 days for that $100,000, I'm willing to pay you $1,000 today, which is something that is actually done in real estate. So anybody that participated in a real estate contract actually participated in a type of call option. So what can happen? If the price of the asset, let's say, goes up from $100,000 to $110,000 over that 30-day period, unlikely with a house, but could happen with a stock, then that $1,000 of option potentially made you $9,000, because you have the right to buy it for $100,000 and make the difference. And if it goes to 100,000 or below, then basically you just lose that option contract. I like that a lot, because as a risk mitigator or a portfolio manager, I get to define my risk, knowing exactly what's in it for me to make or lose when I structure something like that. So what's a put option? The flip side. So if you own a car, you already have a type of put option. So when you want to drive it, you have to put insurance on it. And what happens is that every month you're going to write a check to the insurance company and tell them that, you know, basically they have them insure your vehicle. And let's say that check is $200 and your car is worth $100,000. So you have the same value of a house as you have the same value of a car. So you must be living in Killeen, Texas. So in this case, I saw a smile from Jeremy there.
Yeah, they won't understand, but we can explain it to them later.
Right. So basically, what's going to happen is that if the car gets totaled, you get the full $100,000 for that $200 of monthly premium. So what's in it for you is that you can insure your risk for catastrophic loss for a relatively small price. What's in it for the seller is that they know that they're going to have a large max loss, but they're going to make a consistent monthly premium for insuring against that loss. And if they do it enough times over enough people, then they're going to be able to continuously make those premiums, and they can figure out how much of those premiums they need in case they get that loss. So those are calls and puts, simply stated.
And Itai, let's pause there for a second.
Sure.
I know we haven't really given everybody a chance to ask questions. So, hey, audience, anything between the end of the macro piece or options here that's on your mind, please feel free to just share. Oh, Itai, I think we're scaring everybody off. We have to take our pauses and ask some more questions along the way. Okay, we want everybody's engagement here. All right.
And we have some expert
engagement. Yeah, that's true. So the expert option people, we need you to help participate here. We want to help everybody understand better.
Well, we're about to go into far more complex topics very soon. So this is a very blurry chart that basically just illustrates the main things you can do. So the long call is the option on the house, which you basically, what you could lose is the price you're paying for that option. And if it goes above that, that's how much gain you're going to have. Doesn't matter how much it's going to go up. The long put is the other way around. You can just lose the value of the contract. If you're a seller, it just flips, where your profit is the premium you get paid, and your losses could be exponential in both directions, which would make sense in the insurance example. You make your $200 car premium, but if the car has an accident, you can be on the hook for $100,000 if you just got paid $200, which a lot of people end up in trouble when that happens to them as an option seller. That's primarily why it's a very basic concept. So,
Itai, we did have just a question about selling covered calls. Somebody just wants to know how could they maximize I guess almost the impact of selling covered calls if they have a heavy concentrated stock position, and maybe you want to explain what that is.
Sure. So we're literally going into that. So I'm about to cover two very basic strategies that you could use in order to secure your single stock risk. And after that, we will go deeper into options and how you can actually optimize for even higher efficiency when you do that. So again, the most basic strategy a lot of people like using is the covered call, and how to basically turn your stock into an income producer. So the main idea, and this is a, I hope the chart is relatively legible. Now I'm not sure, but the main idea of a covered call.
It's a little hard to see. Can you zoom this in at all, or?
Yes.
Or people, I think you can fit to window if you click that black box at the top. It says view options, saying you're viewing Itai's screen at screen, then the black box, and you click fit to window. That might be your best help so far.
The black box. Fit to
No, that was for everybody else. For you,
okay.
we don't really have good options.
It's odd because in my screen, I'm actually viewing it in full screen and it looks fine. But so basically what you see here is an example of a covered call. So in this case, you have 1,000 shares of Coinbase. I just chose that one because it's a recent IPO that some people have exposure to, and it's a relatively high volatility option. And I took that snapshot of today. So imagine you had 1,000 shares of Coinbase, and the market price in which you bought it for was $280 even. And against that, you can sell 10 contracts in this example of the September 17, 325 call. So what you're saying in this contract, for example, is that if Coinbase goes between where it is today, 280, and over $325 between now and September 17th, you are going to deliver that stock at the price of 325. So your profit would be anywhere between where you are today, which is 280, and 325 in the future. In order to do that, you're getting paid $9.70. If Coinbase ends up anywhere under that price between now and that expiration date, you get to pocket that $9.70 and basically produce income from that stock. Now, some people would say, well, but my risk is that the stock is actually going to get called away and I can't sell it because of a lockup period or something like that. And what you could do is you can actually close the position beforehand if it gets close to that price, and you may even still make money on it depending on how long it takes it to do that. And that is in very simple the covered call. So imagine you recycle that every single month and you get something close to $10. Then over 12 months, you're going to get almost $120, which is almost half the value of your entire stock position. So if you rinse and repeat that kind of strategy, it can produce quite a bit of income, especially when it comes to a relatively high volatile stock. Okay. And what about those that are worried about a downward move in the stock price that could have an exponential loss to it? The simple strategy number 2 for that is a costless collar. And what do I mean by a costless collar? So in this case, you would do the same thing with the stock, where you would go out and sell those 325 calls. So again, September 17th, same expiration. So you have 1,000 Coinbase stocks, and each contract of option is the equivalent of 100 shares. So if you sold 10 of those at 325, you would still get that $9.70. So in this case, what you would do is you would go out and pay around $8.40. So you still get to pocket a little bit of money, the difference between 970 and 840. And you would buy the $240 puts. And what's going to happen here is that if the stock actually falls under 240, as you can see here by expiration, 9/18/21, doesn't matter how much the stock is going to fall. You can never lose more than that amount between 280 and 240, which is roughly 13–14%. Because even if it goes to $100, your put is still going to protect you because you can put the stock on somebody else, whoever was on the other side of that put contract. Even if the stock went to zero, that will always be your maximum loss. So if you didn't want to optimize for income and you wanted to optimize for protection, you can do that as well.
Itai, why do you like options so much?
So in this case, this would be as if you're trying to structure a portfolio and you want to know what your risk is. What's amazing about options is you can always define your risk. You can always know what your worst case is going to look like, what your best case is going to look like. And you can optimize for whatever it is you want, given whatever investment strategy that you're looking for. Now, the main reason that this investment strategy is so powerful is much more than just having that defined loss at 240. A classic way in which you would use this type of investment strategy, if you had an account, some of the online brokerages, like the one we use, Interactive Brokers, will let you borrow against your own stock at maybe 1%. So if you couldn't sell a stock or you didn't want to sell a stock because you don't want to pay taxes on it, you could, in theory, borrow against that stock and then use the money to do something else, like buy real estate or even invest in equity as an example, and diversify your risk and diversify and invest in more things. But the only way that's safe to do that is if you hedge that risk, that even if the price of the stock collapses, you'd never be getting a margin call, and you're leveraging your money and optimizing your money better and investing it in more places.
Got it. That makes sense. Itai, I saw a question come through. This example, is this similar to a bull put credit spread?
No, this would be a costless color. A bull put credit spread would be when you're selling a put and then buying a lower put in order to make a credit, and you're betting on the stock to go up or stay within a range. This would be to hedge a stock that you already own by using a call that you're selling and using that premium in order to buy the put.
Got it. And all right. And for everybody else, when Itai talked about being able to borrow against portfolios and invest in things like Equi, I did include a link in there in case you are interested in applying to Equi. It's a shameless plug that I have to do. You'd kill me if I didn't.
Yes, it would. All right. I'll forgive you for that. All right. Now that we have covered those two simple calls, I warned at the beginning that we're going to go into a little bit of more complicated topics later down the line. That's going to make it more interesting for some of our more advanced. So let's start with that. That is the most basic concept of option Greeks, which is delta. So what is delta? Delta the only thing delta is represents the rate of change between the price of an option and a change in the price of the underlying. So if Coinbase goes up by 1%, how much would the value of that option going to change? Another way to use delta is probabilities of the option market, where those options are going to end. So this is an interesting way to look at it, where when you have a stock price that's at the money, meaning that let's say the call option is $200 and the stock is at $200, the delta is usually going to be around 50 or 0.5. And the reason is that if you assume a random probability that a stock can go either up or down, there's about a 50-50 chance that that option is going to end in the money. It's either going to have value or it's not going to have value. It's as simple as that. The delta is going to be higher the more the stock is in the money. So in that same example, if the stock was $200 and the option was at 100, so it's a call option for 100 strike, the delta will be really close to 1, because at that point, it doesn't matter if you're holding the option or holding the stock, they replicate each other's movement. On the flip side, if it's really far out of the money and you're nearing expiration, it's almost no chance whatsoever that that option is going to end in the money. And that's why those options have a very low value. Sometimes you have very interesting occurrences where something is extremely out of the money and then it gets to the money because of some crazy event. That's why options can have exponential upside, because the deltas change from a very small number to a very high number, and that can cause a huge spike in the price of an option. I think someone on the call had something like that happening to them when they forgot some kind of extremely far out of the money option, and all of a sudden woke up to find that they were in the money, and that was a very nice surprise. I won't say who that was, but that is the reason that happens.
Itay, if I could jump in for 1 second on delta.
Sure.
There's a third definition of delta that can be very useful for people, and that is that it's essentially the equivalent underlying that you would have by owning the option. So, and that's sort of like the first definition of how much it moves. But so in other words, if you had a 50 delta and you owned an option, it would be as if you had owned half a share. Or for that matter, if you had, 5 options, which is 500 shares, would be like owning 250 shares of stock in terms of how that the P&L would work on the option relative to the stock itself moving. And it can be used as a hedging tool, but also, again, as an equivalent. So obviously, as you'll get into, with changes in implied volatility and changes in time, the delta will change, so your equivalent will change as well. But it's a really useful tool for people.
Yeah, thanks for that. Yeah, I totally agree. And you can plan synthetics, and you can replace a stock position with a lower amount of capital, and a lot of cool stuff you can do.
Well, there's all kinds of equivalents, everything, just like you were talking about with defined risk and defined profit. There's also all kinds of defined, synthetic opportunities, and where you can replicate all kinds of, every stock option position can be replicated lots of different ways.
Larry came in on an alien ship for the rest of everybody, so.
All right, hop into this. This is the option seller's best friend, option buyer's worst enemy, known as Theta. So what Theta means is basically how you price the value of time when it comes to options trading or options in general. So the easiest way to think about it is, if you are buying an option for a longer period of time, so in this example, you're buying an option with 3-month maturity, it's either going to have a value at the end of that 3 months or it doesn't. It's either going to be worth something or it's going to be worth 0. It's going to be worth 0 if it's out of the money. It's going to be worth something if it's in the money. The longer the time you have for that eventual event to happen, the higher the value of Theta is going to be, which makes sense because there's a greater amount of time in which something's going to happen to make it worth in the money. And the closer you get to expiration, the value of Theta accelerates even further. So going back to Bernard's question, where he's asking, how do I optimize for that call selling the most? What I found is when you're selling around 45 days to maturity, the Theta curves that's when it becomes exponential. So beforehand, you're still getting Theta decay, but you can see that the decay from day 120 to day 90 or from day 90 to day 60 is more gradual. When you get past 45 days or so, it starts going exponential, almost falling like a waterfall. Now, it's not good to stay in the very end because you've already maxed out the majority of that time by that point. I found that the best option selling strategies are between day 45 and call it 2 weeks to 3 weeks to expiration. Between that period, you harvest a lot of Theta. You can basically cover that position and roll it again. And that will actually typically be better from what we've tested than waiting until maturity.
Are you selling options that like have a delta of 20?
It depends on it depends on volatility too, and the skew and a lot of other stuff.
But you're selling out of the money options.
Yeah, because out of the money options will have more Theta decay than those that are in the money, right? They would have more. It really depends, but I haven't looked. It depends on the exact strategy that you want to do for that. But I would typically sell the money. There were a few exceptions, and that was basically ahead of earnings announcement and other things like that. I would sell at the money. Other comments, questions?
Yeah, another one was, when should you employ an options strategy versus just buying or shorting the stock outright?
Yeah, that really depends. For me, that was most of the time, because buying the stock or shorting the stock is capital intensive. And you're basically using all your capital to do that. Option gives you an ability to have a certain defined risk, and then basically leverage the value of your money better. And you can also define your risk better and things like that. So for me, I would almost always prefer to use options or futures than do the underlying, with some exceptions where implied volatility is really, really high, and I would basically sell an option against the underlying, with basically using the short option as almost like a limit order to get taken out in certain prices and then continue to recycle it. So
and we can talk about that in the later on section, because I know that's probably over many people's heads.
yeah. All right, continue with basic Greek. So what's gamma? Gamma is rate of change of delta. So when we talked about that, he's like, well, are you selling what kind of deltas? So gamma has a lot to do with that, which deltas you decide to do, because there's a big difference between the delta of, let's say, Coca-Cola or the delta of Coinbase. And because some stocks are much more volatile than others, right? So the delta is expected to move much more frequently. And how do you know if the delta is going to change a lot or not? And basically gamma is what tells you that. So this is a chart of gamma and what gamma looks like for different stock prices. So it's actually similar to the delta graph in a way. It's most stable in the middle and then moves off. So you have the biggest amount of pricing for it in this period. Okay, going back to my favorite one, we're actually going to my favorite one, which would be implied volatility. And I think it's important to note that there's actually two types of volatility out there. There is the realized volatility portion, and realized volatility is basically observation of what we've seen in the past. So in the past 30 days, we've seen huge amounts of volatility, or we've seen little amounts of volatility, and we have a mathematical observation of what that volatility was. And now you have the implied volatility, or the market pricing of volatility, which is in the future state. Nobody really knows what that's going to look like, but the market is still trying to price that, because the pricing of options at the end of the day is pricing of expected future volatility. So a classic example of, let's say, historical realized volatility was relatively low, but the market implied volatility is really high. That's something that can happen maybe before a US election, right? That markets were relatively stable, but nobody knows what's going in the future. So the market would potentially price that differently. So it's important to note that there's two types of volatility. And implied volatility, or Vega, is what I like to think of it as the human element. Because all the other ones are fairly scientific. You have a delta relates to the underlying. Theta is an exact calculation of how much time is lost. Gamma is an exact calculation of the rate of change of delta. But how do you price Vega? Vega is simply priced based on the market, right? So as the market puts a lot of premium into one option versus another option, that is when I think that the option market can get out of whack sometimes, and I'll talk about that. So here is what we call a volatility surface. I know this is an interesting chart. I'll ask the advanced option guys here, what's going on in this chart?
Anyone want to take a crack at it? Is it delta? I don't know. Go for it, Larry.
No, I'm not sure exactly what you mean by what's going on. I mean,
I'm seeing your different put strikes and call strikes laid out by your volatility and your delta.
Right?
And
So
your
here
price and your price change, as your volatility is increasing, it's flipping up to the left.
It's a implied.
and
yeah,
it's
you're
also-
showing a skew.
And it's
mean,
also the tenor, I think, is the amount of time you have left on the option.
that's the amount of time you have on the option. You're correct. And the
Is it
pricing of
correct?
volatility is to the left, and
Implied vol surface chart.
it is a vol surface chart.
Right.
And this
Skew.
So you're seeing a fat-tailed skew distribution to both sides here, is what you're seeing.
both sides, but what's more interesting is you're looking at the time, volatility is priced significantly higher in the near term than it is
Right.
in the latter term. So that's a market in backwardation.
Which is mostly the case, which is more the case than not in an options market.
Correct.
Yeah.
Well, if this was, for example, S&P 500 and the VIX was normal in contango, it would look the other way around.
No, I mean, typically implied volatility is going to still get higher as you approach expiration.
Except on the index.
Not on the index.
On-
That's more common in futures.
Yeah.
So good guess, guys. I love the volatility surface Q function for those of you that have a Bloomberg terminal OVDV. And then you can play around with that. All right, so back to the key question here. Is the option market efficient? What do you guys think?
Yes, very well. It's very efficient in that there's arbitrage.
But if there's arbitrage, it can be efficient, right?
I'm sorry, what's that? I mean, it's efficient in that it's extremely efficient in that puts and calls. The put call parity is extremely efficient. So, I mean, that's where there used to be a lot of opportunity for like on the floor and things like that. In terms of skew, it's not very efficient.
Right, and put call parity doesn't really happen in the index or in stocks. It happens more in futures and other things that have and for everybody's general knowledge, put call parity is basically the pricing of put and call is similar to one another, where in, let's say, the stock market, it's not, because the downside risk is overstated typically because markets go down much faster than they go up. But in gold, for example, it's not the case. Gold can go evenly as fast up as down.
So, Ite, I'm not here to challenge you per se. I'm not here to challenge you. I don't think that is put call parity is about put and calls being equal at any given strike, and that's going to be the same whether it's stocks or futures or paper clips. If you were trading paper clips, the put and the call, taking into effect and factoring in interest rates and dividends, the put and the call has to trade at the exact same value. Otherwise, you end up with you can create synthetic stock versus real stock. And
Larry, you're talking about options that are at the same strike.
Options
correct,
are
and that's
always
what.
Whereas I
what-
think Ite is talking about the distance
Skew.
away from the price. Yeah, the skew.
Yeah.
correct.
Yeah, so you're absolutely right that in the commodities you're going to get much more of a skew, although stocks too, but the commodities for sure. But in terms of put call parity, it's specifically discussing the parity of the call and the put at the same strike.
Yes,
And that's
100%
absolutely
correct.
and that's absolutely defined, will always be the same.
Yes, you're 100% correct. So
Yeah.
my intention is that the skew basically and the pricing of options is much more likely in commodities to be more even across two strikes, unless some kind of event happens, like natural gas in wintertime will have more of an upside skew potentially, right? I've seen that, or stocks a lot of times on the left side.
Yeah, and in my opinion, it's about where's the panic, right? So the fact of the matter is, take food like soybeans, which I traded for years and years. It always had a huge skew to the upside, because the truth of the matter is, everyone's going to panic over not having food. Nobody's going to panic because food prices get too cheap, right?
Yep.
So that's where the panic is, and the stocks is the exact. So in other words, the world's naturally short grains and food, whereas the world is naturally long stocks and bonds. So the panic's going to be the downside, and that's why I think you're going to get more of a skew and a bump in prices on those outliers to the downside in equities, to the upside in most commodities.
You're 100% correct. And that's a lot of what I've seen too. The panic in commodities is upside, especially gold. Gold was, during these crazy periods, sometimes you've seen gold limit up 2-3 days in a row or something crazy like that. Anyway, I wanted to give you guys a little bit of an example from my experience and one of the strategies that I used to do in the fund that was relatively profitable. So wanted to share a little bit of that. And even though that was a little bit ago, I think that that still holds true. So to answer the question is yes, but, which I think most option traders here agree with. So this one is basically a real life example of a trade that was made on Google during the October 2014 earnings cycle. So what we've noticed is a lot of times before earnings reports, you see a lot of volatility just getting priced into options on both sides. And I think a lot of it has to do with some people that own it, they just want to hedge it because they don't know what's going to happen in the earnings report. And then some people that don't own it, maybe they want to speculate. And a lot of it just gets built in. And what we did is, I remember we did that over a few weeks. We looked at all the different results of option earnings, and we've tried to figure out whether or not the implied volatility predicted by the options market was in fact what really happened the day after the trade happened. And it was not. About 87% of the time, the option market actually overstated the real move. So the way you would think about it is, let's say you take the value of the call and you take the value of the put. In a classic example where, let's say the earnings are on a Thursday night and the options expire on a Friday. So you literally just have one day, and you're basically all you have is volatility baked into those options. So if the call trades at $10 and the put trades at $10, the value is $20. That means the option market tells you there's going to be a $20 move in the stock. So we literally looked into it and said, are we really going to have a $20 move in the stock? Yes or no? So you can see here that the term is heavily inverted as well, where all the price of implied volatility was really, really high ahead of the earnings report and then taper off back to normal afterwards. So why does this happen? Actually, just describe that and how to take advantage of it. All right, so we ran a few different strategies depending on the level of implied volatility. But the main idea here is not to sell these naked, because even though there's an 87% chance that that's going to stay within a certain range, in the event that it doesn't, and sometimes that does happen, the move could be so much of an outlier that it could cause an exponential loss. So we always hedge that by buying puts and buying calls over where we sold those positions. So this would be the example where I think the stock traded at 525. So we actually sold the 525 calls and sold the 525 puts. You can see 0% in the money. And then we went out 5% out of the money and bought the hedges. So that's how the P&L looks like. It basically captures a move that would have been just around the range of what just inside the range of what the option market would state. So if it was a perfectly efficient market, the options market would actually be very accurate at predicting how much that stock's going to move. And as I mentioned before, from my experience, that's not the case at all. And the next day, as an example, Google moved below the expected move and opened and settled at about negative 2.54%. And I believe the option market predicted a move that was closer to 6%. And you can see here the next day, the collapse of implied volatility almost immediately back to normal levels. And when you're looking back, that's the pattern of known unknowns, where you have a large spike in implied volatility and then it collapses right away. In this case, it was earnings announcement, earnings announcement, earnings announcement. Sometimes those earning announcements are less of an unpredictable earnings report, but most of the time you do see it falling within that expected range. So that was a strategy we ran fairly frequently across multiple companies. And it was very, very consistent around earnings season. So other things that known unknowns have known to have triggered some of these type of strategies: Fed meetings, elections, earnings events. Brexit was a really good one. Product announcement. Apple sometimes has those corporate events. So just wanted to share that as a little bit, and happy to chat about that for anybody who wants to stay on. That was it for today. Lasted a little bit into over the hour mark, but hope you all enjoyed.
It was an interesting subject, and I think for some people it was a little over the head, but I think for the people who like it, it was
very good.
great. And with that, I'm going to stop the recording and we'll open it up to questions and having fun.